Right now, New York City cab driver is bearish on tech. Okay, and if you look right now, it's a do not enter zone in terms of software.
Bitcoin has crashed again.
A lot of people sold Bitcoin as being the next gold, and it turns out that in the face of doubts about stability, doubts about politics, the next gold turns out to be gold.
Global markets have been on a bit of a rollercoaster ride of late, and that's seen billions wiped from two of our most talked about trades. Yep, I'm talking about big American tech giants and Bitcoin. At first glance, these two may not appear to be linked. But today I've got Melbourne cross-asset reporter Richard Henderson here to explain to me why they are in fact all part of the same broader story and how to look at what may be coming right around the corner. Rich, we've got a lot to talk about. Welcome back to the podcast.
Thank you very much.
So let's step through this one by one and start with crypto. So Bitcoin has halved from its peak, erasing all the gains from Donald Trump's 2024 victory. Are the good times over for crypto?
That's a great question, and it really depends who you ask. What we know is that Bitcoin and crypto, they're so sentiment driven and they're so volatile. This type of huge rally and then massive decline, it's completely in line with past behavior of Bitcoin. And so where do we go from here? Yes, we could see things bump along for a little while. We could see a further sell-off. We could see a sharp rally. It really depends on the sentiment behind Bitcoin, and that's partly informed by the global investment sentiment, which really is now linked to the AI trade in US stocks. And I would add that, we've seen massive selling in gold, massive selling in US tech. It's come back a little bit, massive selling in Bitcoin. These are the three hottest trades of the past year or so. So the fact that they're all facing this kind of volatility at the same time is telling us that sentiment is starting to weaken a little bit.
And what else has triggered this big tech sell-off in the US that we've seen? Is it just that? Is it sentiment, or is there something deeper at play?
There are two acute reasons for the recent pressure in US tech stocks. One is that software companies in particular, and these were really hard hit the past couple of weeks, AI, and in particular an update from Anthropic, which is one of the big AI companies that have emerged the past few years, they had an update that really showed that they can really disrupt some industries, and software would be a prime example. Others are the legal profession, some types of financial analysis. So there are real use cases showing up now where AI can basically eat your lunch. And so investors got really worried and software stocks sold off, and that kind of bled through to the broader tech industry. And at the same time, all the big tech players, the big tech US giants, they were unveiling their quarterly results. And would you believe they were showing a massive increase in spending on AI data centers? So that has caused concern among investors at the same time, basically asking the question, will that investment pay off? Because the numbers are huge. Some are doubling, we're talking about hundreds of billions of dollars. It's amazing money.
But surely, investors could sort of see this coming, right? Like it was only in living memory, right, when we think back to the internet bubble as it was in the early 2000s. Now in 2026, the possibility for AI to cannibalize revenues of these software companies, at least in the short term for longer term gain, are investors just being a bit short-sighted, or are they just applying perhaps older principles of looking at the way of the future?
You really have to keep in mind that ChatGPT came out 3 years ago. So investors have been grappling with this for a while. It's the fact, I think, that you can now start to see active use cases where you can look at a company and say, wow, I own so much of this stock. Maybe this stock will go down by half because this AI tool that just came out can do what they're doing and what they're charging lots of money for their subscribers. They're going to be able to do that cheaper somewhere else. They're going to leave and use an AI instead. There's the real application that we're starting to see. I think that's what's spooking investors right now.
And how much room is there in this space for disruptors in the tech industry? Obviously, we mentioned briefly some of the bigger players, But also looking back, 25 odd years, those at the forefront of the tech bubble, a lot of them aren't around today, right? Like, are there ones to watch here?
It's a really great analogy, and it's one that, it's not new. It makes so much sense. When the internet was coming up in the mid to late 90s and tech stocks went on a tear, many that achieved incredible valuations, they just evaporated. And, Amazon.com, for instance, wasn't a high flyer. It was really struggling at a point in time when it listed. And that's emerged as one of the big winners. So knowing which companies will be the big winners from AI is really an open question. So it's very tricky, and there's a lot of concern around valuation. Are some of these companies worth too much? Are they spending too much? Investors are really unsure about the future. So they're just having to go with what they see.
And Rich, obviously the other side of this coin is what happens if they don't spend enough money? What if they're not bold enough to really seize the opportunity to be forward thinking in terms of where they're going to be putting their capital expenditure, at least in the next couple of years? What's the risk to these, so-called magnificent seven massive tech companies? Could they go extinct if they miss the boat?
It's a really good point. And the way to think about it, as you're alluding to, is, the risk of spending too much, is the risk of not spending, even if you're spending too much and missing the boat, is that a greater risk? And, do investors agree with that thinking too? So they might not punish you on the share price. So that's a really key point. We're at an inflection point. We need to understand this technology. The leaders are going to emerge. And if you're a big tech company, you really have to be in this game. Even if you're not going to be a market leader, you have to be up there with these guys.
In Australia, we obviously don't have a massive tech industry, especially on the listed side. How did Aussie shares do through this latest bout of volatility?
They held up really well, and yeah, exactly your point. I just checked the numbers. Yeah. I just checked the numbers. Yeah, in the ASX 200. Information technology, the sector is 2.2%.
Right.
So we love our banks and miners, basically. So things held up really well. But again, Aussie stocks are vulnerable to sentiment at that global level. And so, just as we saw a big sell-off, Australia wasn't insulated from that, but we've also had a little bit of a rebound as sentiment has improved in the last few sessions. So I think we could see that continue. And you've got to keep in mind, tech stocks in the US, global equities are trading pretty close to record levels now. So we've had this big bout of volatility, this big kind of wobble, but things are pretty robust. And the settings, if you think about global growth, if you think about inflation being under control in developed markets, the settings are pretty robust, pretty healthy. Corporate earnings as well in the US, there's a chunky amount of growth there. So that's really keeping stocks afloat.
And what about more broadly in APAC? A lot of our listeners are obviously diversified across asset classes and across geographies as well. How have they held up?
Asia is having a really great moment because of AI. And it's really interesting that the heavy selling we saw in the US, it was linked to software. Well, in Asia, they produce a lot of hardware that's behind the AI trade, right? And so that's holding up because the demand, as we're seeing from the Mag 7 and others, from Google and all those guys, that demand is so strong that chip makers in South Korea, for instance, are just shooting the lights out. So the benchmark in South Korea, the equity benchmark, it's called the KOSPI, it's doubled in the past year, right?
Wow.
Two companies make up almost 40% of that index, Samsung and a company called SK Hynix. And they are, completely integrated into the global technology supply chain behind artificial intelligence. And that is a market that's just booming. And folks still want to jump in. The rally's got further room, a lot of folks are saying.
So, Rich, what are investors, and strategists saying now? What is the next step for crypto and the stock market, given this roller coaster cadence that we found ourselves in recent times?
So for crypto, I mean, it's always very uncertain, but there's a lot of folks out there who are bullish, who see a lot of that leveraged, the folks trading on borrowed money being flushed out. There are pressures in crypto always, and it's super volatile, super sensitive to risk sentiment. But it might not take much as a catalyst to see the next leg higher for Bitcoin, say, and you can get such sharp swings when the stock market is rallying, when there's global growth, when those kind of background settings are very positive, but again, very volatile, very hard to predict. For the stock market, again, robust earnings growth, robust global growth, the AI trade is still on, there's concerns there, but the potential for revenues are outweighing those concerns. So, so there's still a lot of bullish sentiment in global stocks and incredibly so in US stocks. So there's a lot of supportive backdrop for markets right now, despite these kind of wobbles.
And what are the people you talk to on the daily telling you about the next 6 months for both those asset classes? Yeah,
good question. So I was talking to a guy named Jan Van Eck, who's the global CEO of Van Eck, which is a fund manager. It has a bunch of ETFs, including in Australia. And he was very bullish. I was surprised at how bullish he was, very much bullish on US tech, sees the recent selling and that bout of volatility is quite healthy. It kind of flushes things out. It's a bit of a reality check. Investors have to really question whether they're invested in the right companies. So the fact that we've kind of come through that is quite positive. And again, on crypto was also quite bullish. They have a few crypto ETFs, and he did seem quite upbeat on the sector as a whole. So that I found that quite telling in the middle of that turmoil, that volatility, to be so upbeat. So yeah, I think there's a lot of optimism there on the street.
Is there any outliers? Is there any bears amongst all these bulls?
There's always bears. One CIO had this line I always repeat it to myself now, is that bears sound smart and bulls get rich. And it's a great way to think about financial markets, because financial markets, especially stocks, they're biased to the upside. Over time, they typically go up, all things being equal. And if you look back at if you averaged out the yearly gain for the ASX 200 or the S&P 500 in the US, it's going to sit somewhere between, 6 and 10%. So typically being bearish, thinking things are going to, the world's going to end, it doesn't reward you over the long term. You might be right for a year or two, but being bullish and understanding that history, that bias upwards is quite important to see through moments of volatility.
If you found today's conversation insightful, be sure to follow the Bloomberg Australia podcast wherever you listen, and check for more reading on markets, crypto, and the latest reporting from Rich Henderson at Bloomberg.com. This episode was recorded on the traditional lands of the Wurundjeri people. It was produced by Paul Allen and edited by Chris Burke and Ainsley Chandler. I'm Rebecca Jones. See you next week.